Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in. This is Joe Caccera with the Real Estate Radio Live, the podcast series, as we roll through the week here. The topic today is going to be other purchase options without putting 20% down. I feel like we're going to be moving into a strong purchase market for 2017 in the Bay Area, quite frankly, probably throughout the United States. But with interest rates increasing, what does that mean? And how are people going to finance homes with the rates going up? That could bring some people out of play, so we'll discuss that today. Just a reminder before we get started, if you need any information or help in purchase financing or refinancing, I could help you with those needs. You could reach me at area code 408-838-9060, or you could always go to reradiolive.com. Also, be sure to remember, if you need any resources in the terms of real estate agents, partners, business partners that I have a network with, I'm happy to refer those to you. If you're struggling to find someone you trust, either a realtor, financial planner, CPA, any of those type of people, really in anything around real estate, if you need any help in that, give me a call. Check in or give me an email and be glad to refer someone to you of that nature. All right, the topic today, again, is going to be other options without having to come up with 20% down. The reason I think this is going to be really important to talk about going forward the next couple of months on and off is that there'll be people coming into the market for the first time. There'll be people that may be buying up, but more so for the first-time home buyer. Traditionally, after the kind of the mortgage meltdown in 2008, 2009, underwriting and financing got to be so conservative. It's relaxed a little bit more, but it's still somewhat conservative. A lot of people struggle with or convinced in some cases that they can't purchase unless they have at least 20% down. So that is not correct. And so we're going to debunk that myth a little bit today. I'm going to talk about other ways to finance your purchase with less than 20% down. There are many different ways to do it. Now, it doesn't mean you could someone could afford it. Doesn't mean it's right for you. But we're going to cover the different ways to purchase a home, again, with something other than 20% down. So we'll start. The best place to start is the FHA government-funded loans or government-guaranteed back loans. You could purchase a home for as little as 3.5% down. And they just dropped the monthly mortgage insurance required on those from 0.85 to 0.60, and that means that percentage of the loan amount borrowed is a percentage of your mortgage insurance, which could save you, upwards of $100 to $150 a month, depending on the loan amount that you borrow. So let's start with FHA, 3.5% down. And as long as the loan amount is less than $630,000 in the high area cost of living, a lot of them are upwards of $625,000 plus. As long as the loan amount does not exceed that, you still fall within the guidelines to finance one of these purchases with a minimum of 3.5% down. The other good thing about the FHA is that they're very liberal in the way they underwrite and their guidelines. They allow gift funds, very liberal gift funds. The funds could come from family members, people that could gift that money as long as there's a paper trail for it. They allow for lower than average credit scores. So if you have credit scores that are lower than kind of the average or not as high as you'd like to see them, they do allow credit scores on the lower side. Matter of fact, there are some FHA programs that will allow credit scores all the way down to 580 middle score, which is low, But depending on the reason for that credit scores being that low, there is an opportunity. And so that's a very liberal form of financing when you consider the fact that you could buy a property for as little as 3.5% down and get the down payment actually from 100% of the down payment from a variety of different sources. Interest rates are very good. They're very competitive with the market. Matter of fact, their interest rates typically on FHA, as long as your credit scores are decent, are a little bit better than the conventional conforming non-FHA financing. So you'll find that attractive as well. The two things about FHA you just really have to keep an eye on and be aware of is, one, it has monthly mortgage insurance, and right now it just came down again. It's 0.60, which is not too bad, better than it was before at 0.85. The other part of FHA financing that you need to be aware of is the upfront funding fee that FHA charges. Again, this goes directly to the government, directly to FHA. It does not get paid to the lender of record or anybody else. So 1.75% of that loan amount gets charged. Here's the good news. You can finance that. So that could be rolled right into your financing. You can finance that upfront fee, but it is costly. I mean, if you have a loan amount of, $500,000 or $600,000, that's upwards of, it could be $7,000-8,000. Close to $9,000 in upfront funding fees that gets tacked on to your loan. So if you borrow $500,000 and you tack on another $6,700, you're financing that. That's rolled into your loan, and you're financing that over a period of time. So again, it's a feature of the FHA that everybody needs to know about, but it is an option, and it's a great option for those that don't have the 20% down or more. So FHA, everybody's by now you should be pretty familiar. You could always go to the website. Again, if you have any information, or I should say questions about any of these programs we talk about, I'll periodically during our shows, I'll remind you, if you go to reradiolive.com, you can find my contact information there. You can email me with any questions you have about any of this stuff, the topics that we address. All right, so the next would be 5%. You could get into a purchase for as little as 5% down. Now, there's a couple different options with 5% down that I'll discuss. You could still do it with FHA. The difference with 5% down, depending on your loan amount, there is a possibility to finance one loan, and you still have to pay mortgage insurance that'll either be built into that loan or you pay it separately. And there's some different options to allow that to happen. Typically, depending on credit scores, loan amounts, a lot of different factors, you'll find that the fees on 5 to 10% down, the monthly mortgage fees are going to be about 0.3 to 0.5%. So better than FHA. Here is the good part. There's no upfront funding fee when you do some of these programs at 5 to 10% down. Again, no upfront funding fee like FHA, but you do have the monthly mortgage insurance depending how you go on the 5%. There are some different options I'm going to talk about in a bit about the 10% down. But with 5% down, you do have to pay the monthly mortgage, or I should say the monthly mortgage insurance. But it's a great way to finance a home when you have a small amount of money to put down. And, the beautiful thing about financing with these programs is that you don't have to keep them forever. It allows you to get your foot in the door, have home ownership for the first time, get started building equity, and have your own home. And then a period down the road, depending on how the market goes, as your home appreciates, what you're going to be able to do is get out of that mortgage insurance. And I'm going to talk a little bit about that in the second part of the podcast as well. When can you, how long do you have to have these loans that carry mortgage insurance, and when can you get out of these types of loans? as well. So we'll discuss that in the latter part of the podcast. All right, let's talk a little bit about 10% down as we kind of step our way from 3.5%. We went to 5%. Now 10% down, it allows you a couple more opportunities. 10% down, you could also do one loan, and you will have some mortgage insurance built in there. Same thing, usually about 0.3 to 0.5, depending on the parameters of your credit scores, what you're borrowing, and the risk tolerance of the financing. So good news, again, 10% down. You could get one loan and end up with getting your first property with as little as 10% down. You'll be paying mortgage insurance, but you could secure that financing. The other way that we like to do, what I like to do is recommend and an advocate of is if you have 10% down, I really like the option of doing a first and second loan. The reason for this is that you eliminate the mortgage insurance by going with one loan. And some people might say, well, Joe, I like the idea of one loan. And I know initially that everyone likes the idea of one loan. But the details are really the cost savings, and there's some reasons why. I'm going to go into the details in the second part of our podcast here that talks about the 10% down and why I would recommend in most cases, not all, but I would say the majority of times I will recommend people do a first and second loan when they have 10% down instead of one loan, because you eliminate mortgage insurance and there are no tax benefits on mortgage insurance as well. And that's one of the things that you want to try to avoid is any kind of substantial payments or liabilities that don't have any tax benefits. All right, we're going to take a quick break. When we come back, I will continue talking about different options, other options that you have for purchasing a home with less than 20% down. Go into the details in some of these programs. We'll be back with you in just a minute.
For more information on today's program, visit reradiolive.com. That's reradiolive.com.
Hi, this is Joe Kuchera of Real Estate Radio Live. Thanks for tuning into our podcast. We are your go-to resource for all aspects of real estate, including buying, selling, refinancing, building, and legal and tax advice, and much more. You can subscribe to Real Estate Radio Live podcast on iTunes and Stitcher to listen to an engaging discussion about anything and everything real estate. So make sure you get our app, RE Radio Live, in the iTunes store to follow the show.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit reradiolive.com. That's reradiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. This is Joe Kuchera with Real Estate Radio Live, the podcast series. Today we're talking about other options, other purchase options, I would say, without coming up with 20% down. I know there's a perception out there still to this day that people sometimes feel like you need at least 20% down. Now, if you have 20% down, that's great. That's wonderful. It's going to eliminate some additional expenses and costs that's associated with financing. But the message I really want to get out today and continue to get out, especially in a market in 2017, I think in 2018 we're going to have a lot more purchase activity. The statistics show that we're going to have a lot more purchase activity, and we're going to have 40 to 50% of this purchase activity is going to be from first-time home buyers. So that's why it's important to get this information out to people so they understand the different options in financing. It's a very consuming, overwhelming process to purchase a home if you're not familiar with it. Even if you're familiar with it, quite frankly, it's overwhelming. It could be frustrating because of the conservative nature and underwriting, the things that they ask for you're not familiar with, or it gets very frustrating. So the idea that we want to do here on Real Estate Radio Live is continue to educate and inform you, the consumer. We'll continue to do that and really provide you with as much information as you can to not so much make you an expert. The idea here is not to make you an expert in home buying or refinancing or real estate, but to give you enough information so that you're comfortable making decisions. And then also, the most important thing is to seek out the right people and seek out people you trust that could help you make these decisions. What I don't want to happen, and what I really try to avoid, is having someone make big decisions here and feel uncomfortable consulting with people, or feel like if they ask questions, they're going to be stupid questions, or, I never want that to happen, especially on a decision like this. I mean, if you're buying a TV and you're buying, electronic device that you make a mistake on, okay, so what? It's not going to have a huge effect on your life. But when you're making a decision to purchase a home, refinance a home, sell a home, you really need to be armed with as much information as possible. Educate yourself as much as possible. And educate yourself, what I always say, is to be in a position where you're comfortable asking good questions. Because if you're not, and you're afraid of asking questions, it could be an expensive, you could have an expensive problem on your hands. So always be sure to do that. So the topic today, again, is other options. Other purchase options other than 20% down. The first part of the podcast, I talked about, 3.5% on FHA, 5% down on purchase programs. And then just as we were kind of winding down the first part of the podcast, I talked a little bit about 10% down options and why I would prefer, for the most part, that people do. When you put 10% down, I would prefer, for the most part, that you do a first and second loan. And here's the reason why. When you do a first and second, what it does is eliminates mortgage insurance. And the reason that happens is that there's a lender that goes in first position on the loan. Let's say you have a first loan of, just for sake of conversation, of $400,000, and then you have a second loan of $50,000. What that does is it put the lender in first position, and then their risk that they're taking is the first position of that loan. You're going to get pretty good rates, the best market rates, depending on your credit score and the profile of what you're borrowing. Now, in the second loan, it's going to be a little bit different because the lender on the second is taking more of a calculated risk on the money. And the reason why is there are two reasons there. One, anytime someone is in second or third position on your property, you're going to pay higher interest rates and higher terms because they are taking on a bigger risk. And the reason why is if something were to happen to your property and it would be foreclosed on, then the lender who is in first position always gets taken care of first. It's just the way it is. That's why when you get loans on your property, on most of the time, someone will get a home equity line or a second loan. The rates are higher, and the reason they're higher and the reason the terms are different and more expensive typically is because the lender is choosing to go in second position, which takes on a bigger risk if something were to happen to that property and you were to lose that property. Now, the second part of it is that you're not going to get, typically, even though they're offered, you're most likely on a purchase of a first and second. I would recommend that you do a home equity line second, and what that is an adjustable second, and it would be an adjustable interest rate based on the prime, usually plus something in the terms, and that would depend on a couple things. One, your credit score, how much you're borrowing, how much you are putting down. So a lot of those factors would come into play. And again, this is for an example. If today you had good credit and you were purchasing and you did a first loan of $400,000 and a second loan, let's say, of $50,000, you might pay about 5.5% interest only on that second, just depending on credit scores and different factors. So 5.5% interest only payment on $50,000 is very, very minimal. It's going to be very low. Now remember, that's an interest only payment. And if you pay the interest-only minimum payment, you are not applying anything towards principal. Someone might say, well, 5.75, I should say 5.5 is pretty high, Joe, compared to the market rate. Well, that's true, but in an environment where, let's say, the first mortgage is at 4.125 or 4.25, then again, the reason why the rate on the second is going to be higher is because the lender is taking on a bigger risk, When you take on a bigger risk, you're going to charge more. A lot of people are familiar with this concept when it comes to what's called hard money or private money. You'll see in some cases someone can't get traditional financing, and they'll make a decision to do what's called private or hard money financing. And in private and hard money financing, you'll find that you're going to pay probably 2 or 3 points, which means 2 or 3% of the loan amount borrowed. So if you borrow $500,000, you could pay, upwards of 10 or 15,000. Plus, you might get an interest rate around 8, 9, 10%. And the reason why these are so high, these fees are so high, and the interest rate is so high is because this is a risky loan. This is a risky venture for the people that are loaning this money. The reason why is even though it's tied to your property, what you have is these lenders that lend this private money. There's not a huge appetite in the secondary market that are going to buy these loans like they do conventional loans from lenders. So they take on a bigger risk. And that's the reason why this type of financing is more expensive. I use that example as we bounce back to the first and second scenarios on a purchase with 10% down, because I want to give you kind of a flavor of what happens when you go to finance a property or get money, borrow money on a more risky level. That's what's going to happen. You're going to pay higher rates and higher fees. So to summarize, again, the 10% down, you have the option. You could do one loan and pay mortgage insurance within that loan. Or you could do 2 loans. The beautiful part about 2 loans is that you do not pay mortgage insurance. Because you're doing 2 loans, you're separating that risk. You don't need to pay the mortgage insurance. And the reason I like that for the second part of this is that mortgage insurance is not tax deductible. You do have the tax deductible on your second on the interest that you pay. Remember, one of the big benefits as we wrap up the show talking about these options is that you want to get into home ownership as soon as you can if you could afford it. One of the reasons is that you want to start growing appreciation and have a home of your own. But really the other big part of it is it's a tax advantage. When you purchase a home, right now, as long as they don't mess around with the tax advantages we have, as a homeowner, if it's your primary residence, you could write off 100% of the mortgage interest. Not your payment, the mortgage interest on any loans on your property up to $1.1 million and get 100% of that tax deduction off mortgage interest, and you get 100% of a tax deduction off your property tax. And those are 2 of the reasons right there that make a big benefit in home buying. As we wrap up this show, the options of less than 20% down, you could see they're out there. There's a lot of great options. But remember, when you're running the numbers, and I'm happy to do this for you out there, a lot of people forget to factor in the tax benefits. It's really important. You want to factor that in, because if you're paying a certain amount of taxes, if you're paying, say, a 37 to 40% tax bracket right now and you don't own a home and you do purchase a home, we could run the numbers for you, but that tax bracket's going to change for the positive. You're going to be paying less tax because you're going to be able to get some write-offs and establish some deductions for this home that you have. Really do me a favor when you're looking at this, make sure you meet with a CPA or someone that could really explain this to you in a good way. Oftentimes I feel like it's not explained to people or don't quite understand. There's certainly a benefit of buying a home, but there's a tax benefit that goes along with it that allows you to offset your taxes and really either get more money to make adjustments on your paychecks, and at the end of the year you have the ability, again, to legitimately write off 100% of your mortgage interest and property tax. For an example, if you have a $500,000 or $600,000 loan, you could have $20,000 to $25,000 a year in mortgage interest, and then you might have $8,000 to $10,000 a year in property tax. So you could have $30,000, $35,000, $40,000. You could have, depending on the loan amounts, in deductions for your taxes, and those are all positive things. All right, as we wrap up, just remember always, if you want more information, you can always go to reradiolive.com, and do me a favor, if you get a chance, give us a review. Until next time, take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit reradiolive.com. That's reradiolive.com. Subscribe to our podcast. Discover more at reradiolive.com.